Hi friends, today I bring you massive edition of my previous videos. I was thinking that if you are picking up certain newspapers, suppose Economic Times, and if you are reading the captions and not able to understand what it is really talking about. So I thought that disseminating my knowledge through several videos would not be fruitful if you are not picking up the concepts in the newspaper. So I thought that I should bring certain random topics and captions in order to make you understand what it could be talking about. So since it is a massive edition, I will reflect what I have talked about in my previous videos. I have talked about financial market and different tools of it, the primary market, secondary market, and capital market, money market, and every aspects of financial market, whatever it could be. Even I have talked about RBI and its responsibilities. So I have also talked about how it maintains volatility of Indian currency in foreign exchange rate. So today I'm going to bring certain captions that could be printed in newspaper, and if you want to introspect those captions, you should have a prior knowledge, or you can think in this way. Suppose certain day you are picking up a newspaper and you are getting this caption that inflation has increased and government is thinking to impose several taxes on people, or increase indirect taxes, or trying to think that it could enhance direct tax also, it can. So or it with it another step may come that RBI is thinking to increase repo rate and reverse repo rate. Both could come because these are the two tools which can check inflation in the market. So what is inflation? I have already talked about that. Suppose a certain day you are going to market and you are buying a certain commodities in 1000 rupees, and next day you are visiting the same shop and the same commodity you are having to pay 1100. That means 10% inflation has occurred. So in India, inflation is measured on two bases, that is called wholesale price index and consumer price index. Wholesale price index is the same thing as I have talked about. It is collection of commodities. 676 commodities are assigned in wholesale price index to evaluate its price, and it measures with the base year, and comparing that, it measures how much inflation has occurred really. So if you will talk on a macro basis, suppose taking indirect taxes increase step, or RBI would be thinking about repo rate increase, so they will take consideration of wholesale price index, what it is actually reflecting. So, and there is a consumer price index for for micro level thinking and a speculation, that if they are thinking broadly and they want to check all these things, then consumer price index is there. It has also assigned different commodities, but actually it is based on consumer. So consumers are different types in India. So they have categorized these peoples: industrial peoples and non-working peoples. There are four kinds of consumers in India. They have categorized, and accordingly they take data from it and they compare with the base year, and again they reflect the inflation. So in this way they check the microeconomic inflation. So here what is inflation I have talked about, and how it is checked. Government can increase taxes to check inflation because there is a demand increase in market, that's why inflation has occurred, or the flow of currency has been increased. So in order to take out some money from the market, government may increase indirect taxes, or put some cess on you, or may increase direct taxes, or RBI may take a step to increase repo rate or reverse repo rate, because banking is the bone of economy, and in this way RBI can control the flow of rupees. So these are the two steps government can think. So whenever inflation check will come, government or RBI can take these two steps. So or another day you might pick up certain news that RBI is stipulating certain capital adequacy ratio on banks that they have to maintain, otherwise they have to go through prompt corrective actions. These are the new measures RBI is taking. You know, there is a Basel committee that used to give some standards. It has stipulated that 9% of capital adequacy ratio international fraternity has to maintain in order to be more robust the banks, you know. So capital adequacy ratio is actually the percentage of their risk weighted assets that bank has to maintain. What is risk weighted assets? You know, whatever loans banks give is actually an asset of the bank. So if I am receiving certain loan from the bank is always has certain responsibilities. You know, whatever loan they are disbursing, actually it has a risk. Whatever loan they are giving, either it is 100% fully collateral supported, or if it is not supported, but it has a risk. Whatever loan it is giving, it has 50% of risk. So they have their own method to evaluate the risk. So whatever risk is evaluated of those assets, they have to maintain 9% of capital adequacy ratio of their risk weighted assets in order to meet the Basel III standards. So you know, you now understand what is capital adequacy ratio. So you can understand what it is actually talking about in the newspaper. So these are the things that often comes in newspapers. So we don't try to understand because we think that it needs certain primary knowledge. So I have actually talked about in details what are the responsibilities of RBI and what are the money markets and capital markets and all its tools. So if you want to have a comprehensive idea, you can watch those videos. Suppose another day you find that rupees is getting weaker against dollar. I have told you that in foreign exchange rates market, RBI what does, it controls the volatility of rupees in what happens actually in foreign exchange market. On certain days, if there is excess demand of dollar, then RBI used to sell the dollar, and when there is excess supply, RBI used to buy in order to prevent the volatility of rupees. So if the demand persists, then RBI whatever it has it can do, otherwise they have to accept the volatilities of rupees because rupees will get weaker because there is high demand for dollar. So there are many constraints that we have to think about, market constraints, what makes the demand of dollar to get increased in international market, why the rupees depreciates. But in foreign exchange rates, I have given you a broadly idea that how RBI controls the volatilities of rupees. If the demands persists, it cannot control, there will be a depreciation in rupees. So now we understand this, and I will be bringing some new ideas. I was thinking that I have talked about risk weighted assets, but I did not give you an idea of capital, what kind of capital bank has. Tier 1, Tier 2, Tier 3 capitals, these are the capitals of banks. So I will talk in different session the assets and capitals and other things of banks, the classification of that, and in detail I will talk about. But today I was just trying to give you some warm up in order to understand whatever I am talking about and disseminating. I am just trying to channelize my own thoughts and readings through you. So keep watching. I will be bringing in new ideas, not only about banking and economics, but I will pick up other subjects also, and I am trying to give you some knowledge that I have and I can channelize through you. Thank you for watching.